Uh, so talking about, what I thought was, I genuinely believe this. I am just giving small little chota sa ek problem, where after the ratio, you get this number, imaginary number, and based on that, I just show this is how it is to be done. And but we will in one of the sessions we will take a balance sheet and then analyze all the ratios. That's fine, right? So then we know how to search it from the balance sheet and the profit and loss account. So, working capital turnover, it is an efficiency ratio. You remember we were talking about efficiency ratios yesterday, where we said how efficiently you use your assets to generate sales. So, we said I am using 10 crores of assets to generate a turnover of 50 crores, right, sales of 50 crores. So, my asset turnover is 5 times. In the example that we were giving yesterday, even though just to remind you, you are giving this example, assets 10 crores, this is my business, my business. This was somebody else, B, I am just write B, 10 crores. Sales 50 crores, 70 crores. So, using assets of 10 crores, so my asset turnover is 5 times, which is sales by assets, here it is 7 times. But if my net profit ratio is 10% and for this person it is only 5%, and why is that? Because using the sales, I only do high quality sales at high prices. So, my net profit is 50 crores ka 10%, 5 crores say, and his net profit, he is selling at a low price. So, he is able to generate more sales, but his net profit is only 3.5 crores. So, do you see that the net profit ratio 10% and there it is 5%, and that is what we were saying yesterday, right? Didn't I say this? Why are you all looking blank? मैंने बोला था ना? So, just as we had, so what it meant, and didn't I say this also, कि return on assets was net profit by assets, which is the same as net profit by sales into sales by assets. Do you remember that?
Yes.
Yeah. So, this thing is cancelling out, right? So, we said net profit, return on assets is net profit by assets. So, it is a interplay of two forces, net profit by sales and sales by assets, right? Are you getting it, that even though I am using 10 crores of assets to generate only 50 crores of sales, while my competitor is generating 70 crores, but I am only doing higher price sales. So, I have a better margin, while he, for example, let us say it was Aman, is grabbing every single customer, right? In the process, he is having more sales but less profits. So, these are different business strategies, right? So, what is working capital turnover? Sales divided by average working capital. Just as we had this thing asset turnover, we also have working capital turnover. How efficiently you are utilizing your working capital to generate sales. I was talking yesterday that she has gone there. We said na ki I am utilizing your money, I am utilizing by paying her late, or basically having a high account payable collection payment period of 120 days, while selling to them either in 0 days or either in cash, 0 days means cash, or giving a smaller credit 30 days. Then I am effectively utilizing her money to generate sales, and that shows, in some ways it is showing efficiency. You can say it is you are very selfish or all, that is a separate issue. But the truth is, it shows efficiency and smart business strategy, because when you are in business, there is intense pressure to generate profits, intense pressure to be cash rich, right. So, what this is showing is, let us look at the example. Sales was 280 and 300, net working capital is 110 by 127. So, working capital turnover is sales divided by net working capital. So, it has gone down 2.55 to 2.36, and average working capital turnover, you see this word average. So, this is based on closing. You might have seen this every time, right. In every slide I have just calculated one for the closing, one for the average, and the numbers are differing, right. So, but average gives a better picture, because here it was low. The working capital, the sales rose from 280 to 300, working capital rose from 110 to 127, and the average working capital turnover is 2.53 that way, right. So, this is basically showing, for the same amount of working capital, how much sales you are generating. So, for a working capital of 127, if our working capital was 1, our sales is 2.5. If our working capital is 100, our sales will be 253. Since our working capital is 127, our sales is 300. You got what I am saying? Next. So, just as we have asset turnover, working capital turnover, we also have the shareholders equity turnover. Again, when we talk about turnover ratios, turnover means sales. So, when we have turnover ratios, almost always sales will be in the numerator, and then something else will be in the denominator, just to measure how efficiently we are utilizing our assets, working capital, equity, etc. You may remember receivables turnover, right, credit sales upon average debtors, inventory turnover. Only in case of inventory turnover, we do not take sales, we take cost of goods sold. But for all other turnover ratios and for accounts receivable, by definition, accounts receivable will be generated when there is credit sale. So, we take credit sale, right. So, otherwise, when we have a turnover ratio, you will have sales almost always in the numerator. So, this is measuring how well we are utilizing our equity to generate sales, and actually it is not a great ratio. This was a better ratio, because assets to sales has some linkage. I put up lots of machineries, I put up a factory, the factory will produce goods and then I will generate sales. Are you getting what I am saying? This ratio is not a good ratio, but accountants bana dete hain, because equity, assets, if you remember, can be financed through either debt or through equity. Assets can be financed either through debt or through equity, and how you generate sales is linked to assets and not to equity, because whether I use 10 crores of assets to generate 50 crores of sales, whether I financed it as so I am just dividing it in two parts, debt equal to 1, equity equal to 9, right, or debt can be 5, 5, or debt can be 9, 1. No, it would hardly matter, this part. Are you seeing what I am saying? The blue part will hardly matter, because the important thing was how you use assets. You use assets to produce goods and which will help you to generate sales. How the asset was financed is not that important for the purpose of generating sales. How the asset was financed has other implications, but not for generating sales. What kind of other implications it has? If you are heavily indebted, your interest cost will go up. Second is, if you are heavily in debt, your ability to raise further debt goes down. कि भाई if you have already taken 10 crores from me and you come back again, can you give me 5 more crores? I will like, यार, I have given you 10 crores, कर क्या रही हो? You get what I am saying? So whether it's a bank, whether, and we will see a slide on leverage, and what we will do is you all prepare, write that also. Huh? So we will do the leverage exercise in a couple of minutes. But before that, let's just introduce the topic. We have actually discussed this topic very, very briefly on session 9 when we spoke about short term solvency and long term solvency. And we said short term solvency is measured through ratios such as current ratio, quick ratio, inventory turnover, accounts receivable turnover. They are all measures of short term solvency, whether you have or will have enough cash in the short run. Then there are long term solvency ratios, and they are evaluating the margin of safety available for lenders represented by owner's equity, ability of the firm to earn sufficient surplus to meet all the long term commitments. One of the biggest measures of long term solvency is whether you are solvent in the long term. 5 साल बाद can you repay all the interest and all the principals that for all the loans that you have taken from public. So debt equity ratio or the debt equity class of ratios are the biggest measure of long term solvency, because if you have there you might have heard Infosys is a zero debt company, right? So then there is no risk. There is no risk. Do you see that? But there are companies which are heavily in debt, and we will see some examples right now in the next 5 minutes that if you are heavily in debt and if your earnings is going down, then you are in deep trouble. So debt equity ratios are claims against assets. Against this we already know, and we already know this next. There are multiple versions of this ratio. If you have forgotten, just give a note saying this is what I have, this version I have taken. Total debt 195, 160, shareholders equity, and by the way these are all examples of your book only, from Horngren book. Most of the examples are either from, you saw Colgate Palmolive case which is in your book, or from Tools and Tools case which is again in your Horngren book. Yeah. So debt 160 to 195 rise, equity rose from 110 to 135. So total debt to shareholders equity is 160 by 110, which is 1.45, 195 by 135, 1.44. So broadly both debt and equity rose in the same proportion, right? And what is total debt? Total debt, you take current liabilities and long term liabilities. If you remember, your balance sheet had assets equal to liabilities plus equity. Within liabilities you had two components, current liabilities and long term liabilities. So both are taken, right? There is a version of this ratio called long term debt to equity ratio. Long term debt to equity ratio, in that case you do not take current liabilities, in that case you only take long term liabilities, and equity you know is same as net worth, right? For every rupee of shareholder funds in the company, there is 1.4 of lender's claim. As you can see, debt is 1.4 times that of equity, right? So, you know, if you think of it as a pie chart, 1.4 by 2.4 broadly. So 60%. This would have been 50-50, but another 10% belongs to this part, all belongs to debt, and the shaded part is debt, white part is equity. So this ratio is 60:40 currently, broadly, right? If it keeps rising 75-25, very soon debtors will be alarmed, because you are playing only with our money. Where is your money? In banks, they have these norms. There are like Basel norms. Has anyone worked with a bank? You are aware of Basel norms, right? They specify that you need to have a certain amount of share capital. ठीक है, bank's job is to take loan. So what is the role of a bank? I will borrow money from you and I will give money to you. I will borrow from you at 8%, which you call as FD, and I will give to you as a home loan, car loan, education loan, etc. at 10 or 12%. So, I will borrow at 8% and give at 12%. So, that 3 or 4% extra goes to my pocket, right. That is the job of a bank essentially. And lower the lender's claim to shareholders' claim, lower are the demands on firm's earnings for meeting fixed commitments, and there is lesser leverage in the capital structure of the company. And now do the Excel exercise now. Let us all do now. Let us talk about in the first scenario, in scenario 1 and scenario 2. Scenario 1 is a 100% equity case, no debt. Scenario 2 is 50% debt and 50% equity. Then we have scenarios 3 and 4, where we have 75-25 and 25-75, right. And then we will see ki 100% equity means 0% debt, right. So, number of, let us say our total requirement of capital was 10,000, let us say rupees, say 10,000 rupees. You can think of it in crores also if you feel ki 10,000 kam hai. So, number of shares, if it is a 100% equity, if the price per share is 10 rupees, let us say book value, market value sab, the number of shares is 1000. So, the market value of shares is 10,000 and the total capital is 10,000. And if it is a 50% debt and 50% equity, then the total capital will be only 10,000 only, but debt will be how much? 50%, 5,000. So, equity is how much? 5,000. Price per share is 10 rupees. So, number of shares is 500. Is that clear? Similarly, a third case is taken where 99.9% debt, 10,000, 99.9% debt, so 9990 debt. So, equity is 10, price per share is 10, so number of shares is 1, right. Now, look at various scenarios. For the same business, this very business with total capital of 10,000, we have 6 cases. Operating income is 0, 500, 1000, 1500, 2000 and 2500, right. Since for scenario 1 we are having interest for no debt scenario, no debt means 100% equity, and so what is the interest? Interest is 0, interest is 0. What is the net income? 0 minus 0 is 0, 500 minus 0 is 500 and so on, 1000 minus 0, 1000 and so on. What is the number of shares in this particular, in scenario 1? We are talking of scenario 1, 1000 shares. And what is the EPS, which is net income upon net number of shares? 0, half, 1, 1.5, 2, 2.5. This is the most basic case. And then we will now play with numbers to understand how financing through more debt or more equity affects our profitability, and this is called as a capital structure. Capital structure decision means deciding on the quantum of debt and the quantum of equity, or the proportion of debt and the proportion of equity. First scenario is understood by all, right. Actually all the calculations are done, but my recommendation would be scenario 3 and 4, rather than copying from my sheet, do it yourself, then you will learn better. Are you getting what I am saying? Yes. Do it yourself, khud practice karo. So, EPS, so can you see that in scenario 1 there is no debt, EPS is rising steadily. EPS is rising steadily. What is the earning per share? In case 6, earning per share is 2.5, right. Let us look at scenario 2 now. In scenario 2, we assumed 50% debt and 50% equity. Operating income remains the same. Operating income does not change because this is EBIT, this is earnings before interest and taxes, and taxes we have ignored. Taxes we have ignored in this discussion, right, because taxes will have some other impacts, but at least for the initial discussion let us ignore taxes. So operating income is 0 to 2500 and interest for 50-50 scenarios is how much? 50% debt and 50% equity. So how much is the debt? 5000, assume 10% interest. So on 5000 we have 500 as our interest cost, right? If that is the interest cost, then net income, operating income minus interest is what? 0 minus 500 minus 500, 500 minus 500 0, 1000 minus 500 500 and so on. So do you see that in case 1, when we had 0 income, in case 1 when we had 0 income, but we were burdened with 5000 rupees of debt, we were in loss zone, because we still have to pay interest. But in case 1, in equity case, fine, we have 0 income, but we do not have to pay anything. So we are actually in case 1 with 0 income, our net income is 0, number of shares is 1000, so EPS is 0, fine. Per share we did not earn anything, but at least we were not in loss zone. Per share we did not earn anything, but we were not in loss zone. Are you seeing that? In case 2, again here we had earned a little bit of money, right, half rupees per share. In case 2 here, because the 500 rupees was the EBIT and 500 was spent as interest, so we are left with nothing for our shareholders. So if in cases 1 and 2, are you seeing that for cases 1 and 2, scenario 1 is better compared to scenario 2 in terms of EPS, right? Case 3 is the break even point or the break even scenario, that it does not matter whether you are having equity or debt. Case 3, between the two scenarios, are you getting it? Because EPS is the same, 1 versus 1. Why? And why was that? It is actually written here. I just realized later that the answer is sitting here. What is the total capital? In both the scenarios, how much is the total capital? 10,000, whether it is scenario 1 or scenario 2, total capital is how much? 10,000. In case 3, 10,000 mein, how much is the operating income? 1,000. So the point is, how much is the business earning? 10% EBIT. Business is earning 10% EBIT on capital. How much interest are you paying? It is also 10%. So when the business is earning 10%, whether that 10% is going to equity or whether that 10% is, because interest rate is 10%. Are you seeing what I am saying? So that is the reason in scenario 3, it does not matter whether you are in case 1 or in case 2, because business is earning 10%, debt is 10%, so equity will also get 10%. Did you see what I am saying? And that is the reason, see, now let me pull it down. Are you seeing the reason? Now look at the 3 comments. If you borrow from bank at 10% and business is generating 10, here it is generating how much? 10%. Here his business is generating how much? 5%. Business is generating 0%. Business is generating 15%, 20% and 25%. So when in case 3, the reason it is equal is business is generating 10% and you borrow also at 10%, yes, then it does not matter कि borrow किया या equity से आया. But in cases 1 and 2, business is generating less than 10%, 0% or 5%. In cases 1 and 2, business is generating less than 10%. Are you seeing that? But you have to pay how much to the debt? 10%. If you are earning up, I borrow from her at 10%, I borrow from Ekta at 10%, I am making 5% return. नुकसान ही हो गया ना, बोला कि यार उससे 10% लगा के शेयर मार्केट में, आई बोरोड इंटरेस्ट, आई बोरोड लोन फ्रॉम हर 1 लाख रुपीज, 10% रेट ऑफ इंटरेस्ट, आई इन्वेस्टेड द सेम इन द स्टॉक मार्केट, स्टॉक मार्केट में आई अर्न 5% रिटर्न। बोले 10,000 पे करके 5,000 कमाया तो क्या कमाया? आई एम इन लॉस जोन। I borrowed from her at 10%, 1 lakh rupees. I invested in stock market, I earned 10%. I am in no profit, no loss. क्यों 10% कमाया, 10% दे दिया, खत्म हुआ. I borrowed from her at 10%, I invested in stock markets and I earned 20%, 25%, 30%. Then I can say कि हाँ, even after paying her 10% interest, there is still something left for me. Are you getting what I am saying? So that's what is happening in, look at, now read these comments. If you borrow from bank at 10% and business generates 10%, you are okay. Okay as in no profit, no loss. If you are borrow from bank at 10% and business generates more than 10%, you are better off. Cases 4, 5, 6, you are earning 15%, 20% and 25% while you have borrowed at 10% and therefore you are in profit zone. Cases 1 and 2, you borrowed at 10%, but you generated less than 10%. You are in loss zone. Are you seeing that? In cases 1 and 2, EPS is lower in these two cases compared to this. Case 3 is the break-even case. It does not matter which side you are in. And cases 4, 5 and 6, you are better off in scenario 2. Why? Because you are borrowing from Ekta at 10% and you are earning more than 10%, 15%, 20%, 25%, therefore you are in profit zone. So this is what I was expecting. So I didn't realize that the first line was partly visible and you had the slide. So ठीक है. So okay, everyone who answered, 3 या 4 लोगों ने same answer दिया, everyone gets that, let that 2 point that I had offered to class be split between those 4 people. 0.5 each है. सबने एक ही तो आंसर दिया था, बस इंग्लिश थोड़ी सी चेंज कर दी कि माई इंग्लिश इज बेटर देन हिज और हर्स, राइट? सो इज दैट क्लियर? सो नाउ ऑल ऑफ यू देखो द सॉल्यूशन ऑल. अच्छा, नाउ लेट मी टेक एन एक्सट्रीम केस सिनेरियो. एक अलग ही सिनेरियो है. दिस सिनेरियो आई एम टेकिंग एन एक्सट्रीम केस. 10,000 rupees total capital, out of it funded from debt 9990, 99.99% funded by debt, only 0.01 funded by equity, 10 rupees, 1 share of 10 rupees. Are you getting the case?
Yes.
For this case and case 6, how will it look like? Case 6 for this case, 2,500 of, see this is already एकदम light shade है यहाँ पर, ठीक है ना? 2,500 of EBIT. How much do I pay as interest? I paid 999 rupees on 9990. I paid 999. How much is the net income? 2,500 minus 999, 1501. What is the number of shares? 1. So what is my EPS? This is the extreme case. My EPS is how much? 1,501 rupees. We are talking of EPS of 2 rupees, 3 rupees, 4 rupees. And here we are talking of EPS of 1,501 rupees. Are you seeing that? So, and that's called trading on equity. It's like the extreme case. It is the extreme case and it will go against you also. In case 6, it is going in your favor. But if you do that for case 1, you will realize income is 0, interest is 999. So net income is minus 999 on 1 share. So per share you are losing 999 rupees. Are you getting that? So if you are wondering करना क्या है, करना है scenario 3 and 4. देखो scenario 1 क्या था? 100% equity. This is 50%, 50-50. So scenario 3 हो गया, एक में 75% equity and 25% debt, एक में 25% equity and 75% debt. So just do that yourself and see for it. It's already done for you in sheet number 2. It's already done for you. But अपने आप करो थोड़ा. You can copy sheet number, this first sheet, and then play. And do you notice Did you note that case 3 in all 4 scenarios, case 3 is generating an EPS? Did you notice this? In all 4 scenarios, case 3 is generating an EPS of 1. Why? Because you are borrowing at 10% and paying at 10%. No, you are borrowing at 10% and generating income at 10%, right? So, 10% total RI, and that is the reason its EPS is 1. Higher the debt, cases 4, 5 and 6 are always profitable. Are you noticing that? Higher the debt, cases 4, 5 and 6 are always profitable. If equity is high, then cases 1 and 2 are better. If equity is high, cases 1 and 2 are better. Are you noticing that? जैसे इसमें भी scenario 1 में was much better, right? Because equity was high. Scenario 3 में क्या है? 75% equity. Scenario 4 is 75% debt. So, scenario 3, if equity is high, then cases 1 and 2, ठीक है, ये negative है, यहाँ positive है, but it is better. Are you seeing that? And are you able to intuitively now see how gearing, this is called capital structure decision. Are we all at least seeing what is happening? This is called capital structure decision. How gearing, how the composition of debt and equity affects the profitability of the company, right? But the key thing will always be what I told you. If I borrow from Ekta at 10% and I generate less than 10%, then it was foolish of me to borrow. If I borrow from Ekta at 10% and I generate 10% only, then it does not matter really whether I borrowed or not. And if I borrow from Ekta at 10% and then I am able to generate 20%, 30%, that is when I am in the profit zone. That is the essence of individual transactions and for business. You see, first case, we have a net income of minus 250. This case, I am talking of scenario 3 and 4, case 1. Net income is how much? Minus 250. Assuming tax rate is 1/3, it is usually 30% plus some surcharge, this percent, that percent, and so overall it comes to almost 32, 33%. So, I have just taken 1/3 tax rate. If I have a loss of 250 this year, I can set it off in future years as per tax laws. So, what it means is this year I have a loss of 250, next year I have a profit of 300, I do not have to pay tax on 300, I have to pay tax on minus 250 plus 300 equal to only 50 next year. So, next year I will get a benefit in taxation because I incurred a loss this year. This is called as tax shield for losses, tax shield for losses. So, how much is the benefit that I will get? If tax rate is 100 rupees, then it means I have to pay 33 rupees as tax and 67 rupees is left with me, right? And so, effectively 1/3 is the benefit of taxation. So, next year I will save on the first 250 rupees of my income, I will save 1/3 of 250, which is 83.3 rupees of taxation I will save next year. So, this is called as tax shield for loss. So, this is shown as minus 83 because this is a shield, not an actual tax payment. This is like the benefit that you will receive because of your loss. So, my real loss this year is not 250, but after considering the tax shield, the tax benefit that I will get next year, my real loss is minus 166.7. Are you seeing that? Yes. My loss this year is 250, but on a loss of 250, I will get a tax benefit of 83.3 next year, and therefore, my real loss is not 250, but 250 is the loss minus the tax shield, the tax benefit that I will get next year, which is 83.3. So, my real loss is not 250, my real loss is minus 250 plus 83.3. Why minus this? Therefore, it is written as minus, and therefore, it is minus 166. Are you seeing it? My real loss this year is my loss this year is 250, but on a loss of 250, I will get tax benefit next year of 83 rupees. So, my real loss is 250 minus this 83, which is 166. Are you all clear now? Okay? So, my suggestion is then play with this Excel sheet which you all have, and over the weekend thoda sa introduce the tax shield wala column for all, because I have only done it for scenario 3. Are you seeing that? For scenario, look at this: EBIT, interest, PBT, tax, PAT. That is what we have done, right? So, but this is only done for scenario 3, not done for scenarios 1 and 2, not done for scenario 4. So, bring tax into play and see how it feels. ठीक है ना? So, this is next. So, we have already discussed this long term debt to equity. I have just mentioned in the previous slide when we were saying that you can take long term debt also, right? Long term debt to equity. So, if the long term debt equity is the same in the previous example 110 and 135, but we have removed current liabilities and only considered long term, because you know working capital you are financing at times through short term bank loans, but otherwise business में थोड़े पैसे अटके रहते हैं, which is taking care of, which keeps getting rotated. The money that I have to pay to her, I will pay once you all pay me. So, then I will pay to her, then I will buy from and sell to you, again you buy. So, this is like a cycle, right? That is the reason it keeps getting rotated. So, that is the reason when we measure long term solvency ratio, we ignore the current liabilities portion, because current liabilities we usually do not pay from our long term assets, we usually pay current liabilities from our current assets. So, that is the reason it is a better idea to actually, this ratio makes more intuitive sense, because long term debt is a method of financing only, equity is also a method of financing, and both are long term in nature. So, we compare long term with long term is better than comparing all debt with equity. Okay, you can do both, you can, that helps you to even have a better analysis. See, this is the essence of what it is saying. Long term debt is how much? For every rupee of owner's fund, there is a long term debt of 0.67 only. So, look at this number for 2007, long term debt 90, equity 135. So, long term debt, if you look at the proportion, it is 40:60. Do you see that? If you look at the proportion of total financing, out of 225, 90 is debt, 135 is equity, 40:60. How, where is 225? 90 and 135, joint total is 225. So, 40:60 की ratio में हमने 40% is long term debt, 60% is equity. Are you seeing that? The other way of putting is, for every rupee of owner's funds, we have a debt of 0.67 only, which is the same thing, right? Are you clear? Clear now? Next. Again find the same thing, but a different ratio, long term debt to fixed assets, measuring what? How much of fixed assets are financed by long term debt. So, fixed assets are supposed to be financed either through long term debt or through equity. Some of these ratios are interconnected. From the previous ratio and this ratio, you can find out each other. If you know that long term debt to fixed asset is long term debt by net fixed assets, long term debt is 80:90, net fixed assets is 94 and 79, almost equal, see. So, effectively net fixed assets are financed by long term debt here. Do you see that? And this is the percentage, long term debt to net fixed assets, it is 101%, 96%. So, effectively long term debt has been financed by, net fixed assets have been financed by long term debt, but they are also, that means there is a lot of working, what it is showing is there is a lot of working capital employed in the business, because जो equity वाला पैसा है, if you think of it, why is this a little bit surprising? Because the net fixed assets is very low, that means the current assets are very high. Are you seeing what were we saying in the previous slide? Can you go to the previous slide? Long term debt 80-90, equity is how much? 110 and 135. Let's go to the next slide now. Long term debt 80, but net fixed assets is almost the same as long term debt, right? Broadly it is the same. That means a lot of the money is stuck in current assets. Maybe too much of money is stuck in inventories and fixed assets, or there are some other, there is another possibility, you might have bought some business, a lot of the money is stuck in those intangible assets called goodwill, which you have to amortize over 2 or 3 years. You remember that concept? So, that is also possible कि a lot of the money, but it is actually a cause of concern. Are you seeing what I am saying? It is a cause of concern that fixed asset, in spite of debt being only 2:3, long term debt 40, equity 60, but all of net fixed assets. So, if you sell all of your net fixed assets, you are only getting rid of your debt. Are you getting what I am saying? तो equity के पैसे कहाँ गए? What will the equity holders get if the business is liquidated right now? Very little, unless the money is stuck in current assets, because otherwise either it is in current assets or it is in some intangible assets like goodwill and so which will eventually be amortized to 0. Are you seeing the cause of concern? Okay, next. Net fixed assets, if you remember, gross block less net depreciation, that is net block. So, that is net fixed assets. And why do we use the term block? We said we use the term block because in a business you will have multiple assets, you will have machineries who will be depreciated at say 10%, 12% depending on the life of the machinery. If the life of the machinery is 10 years, machinery will be depreciated at 10% per annum. If the life of the machinery is 5 years, it will be depreciated at 20%. Then in the business you will have the building, the life of the building is 50 years. So, you will depreciate building at 2% only. In the business you will have land which will not be depreciated. In the business you will have laptops and cell phones for all the employees of the company. So, laptops and cell phones will be assumed to have a life of 3 years usually. Okay, and then you will have to depreciate them in 3 years. ठीक है ना? So, they are one block of assets. Then when you calculate depreciation, you will take laptops, cell phones as one block of assets. Why? Why one block? Because they are having the same rate of depreciation. So, you can depreciate if you have 50,000 employees with 50,000 laptops and 50,000 cell phones. Will you account for each depreciation individually or will you account for depreciation on a joint basis? बोले कि यार 50,000 लैपटॉप, each laptop let us say is worth lakh, 1 lakh say. So, we have like 50 crores of laptops and cell phones. So, instead of depreciating every single asset, you will say 50 crores of laptops and cell phones, we will depreciate at 1/3 every year, because the life is 3 years. So, 33.33% depreciation. So, approximately 16.67 crores of depreciation every year. So, that is the reason we have the gross, that block system, because in a business here with so many people, so many assets, why do you want to pass lots of entries? बोले एक entry pass कर दी, you can keep, accountant बूढ़ा हो जाएगा. If you had to pass कि इस laptop की, let us pass the entry for depreciation for this laptop and all the 50,000 laptops and then all the 50,000 cell phones. Are you getting what I am saying? So, you club them together, that is a block of assets with the same rate of depreciation, and then you call them gross block less accumulated depreciation is equal to net block. Got it? Times fixed charges covered. This is basically You have all this fixed. This is exactly actually what we were looking at cases 1, 2, 3, 4, 5, 6. Are you intuitively? This is what we were discussing, that EBIT is how many times earnings before interest and fixed charges is how many times of your, think of it as EBIT in the first instance, think of this as EBIT divided by interest. Let us go back to our Excel sheet. Let us go to this case only, the first sheet. This is EBIT. How many times is EBIT of the interest? This is what this ratio is measuring. So, if in the no case, if there is no interest, there is no fixed charge, तब कोई headache ही नहीं है. There is no headache, right? You are a free bird. किसी को कुछ देना ही नहीं है. Loss profit सब अपना है. There is no headache. But now look at case 2. You have no income, you have no EBIT, but you have fixed charge. Because you borrowed through a bank loan or through a debenture, you have a fixed charge of 500. Do you see that? So, EBIT is how many times of fixed charge? In case 1, it is 0 times, ulta ho gaya. We have more fixed charge and no EBIT to pay it. Case 2, EBIT is how many times the fixed charge? 1 times. So, EBIT is just sufficient to pay the fixed charge. Are you seeing that? Case 3, EBIT is 2 times the fixed charge interest. Look at it as EBIT upon interest only. Fixed charge is nothing but interest for, and then you will understand it. Case 4, EBIT is how many times the fixed charge? 3 times. Case 5, EBIT is 4 times the fixed charge. Case 6, EBIT is 5 times the fixed charge. Let us say you are sitting, this is the real business scenario, let us say, or this is the real business scenario. EBIT is same as fixed charge, you are not earning anything. If the business situation worsens, you will shift to the loss zone. If the business situation improves, you will shift to the profit zone. Are you seeing it mentally? Why this ratio is important? Because you need to know, just as we were looking at current ratio as current assets upon current liabilities, and we said to measure short term solvency, even if the current assets go down in value by 50%, you will still be able to pay your current liabilities. Do you remember that comment from my side on day 9? I said that. In case 2, we are just having enough money just to pay the fixed charge and with nothing left in our pocket for our shareholders. Case 3, we have double the amount available to. So, at case 3 we know that we are not really doing great, but even if our income goes down by 50% from 1000 to 500, we will still have just enough to take care of our interest charges, the fixed charges, that the fixed cost that we are already committed to because of our capital structure decisions. You got it now, understood? So, this is what that ratio is measuring, times fixed charges covered. What is time series analysis? We are examining ourselves over time. On 14th of July, you had zero, if you are assuming you are an engineer, you had practically zero knowledge of accounting and finance. So, we said we will examine our development over time. On 14th of July, I was 0. On 14th of August, I knew something. Then you evaluate yourself on 14th of September and so on. You remember that comment? So, that was the time series analysis where you are comparing yourself over time. So, business is comparing itself over time. Then we said there was a cross sectional analysis where we said I am doing this, but Ekta is doing much better. So, you are comparing yourself with your competitor. Then we said okay fine, Ekta is doing like this, but then you take a benchmark. The girl who stood first in the MBA this year, she got a GPA of 9.2, she had 100 out of 100 in accounting. So the benchmark is that 100 out of 100. You remember that? So we compare ourselves over time, that's time series analysis, with competitors, that's cross sectional analysis, or with industry, and with some leading benchmark that okay, the best ever student at IIM Sirmaur got 100 out of 100. So I have to reach that level, right? Hi, this is Dr. P. Sanjay, and I am a professor at Indian Institute of Management, IIM in Sirmaur. If you like my videos, please feel free to subscribe to my YouTube channel. Thank you.